Hello everyone, welcome to the quarterly call on equity markets. We will look at how markets fare during the quarter. We'll also look at some of the key events and talk about the outlook and how we are positioned as a fund house. We saw extreme volatility with Nifty hitting a low of 7% during the March ending quarter. While the Nifty has recovered and is now flattish versus December, the Nifty mid-cap and small-cap index are down by 10% and 14% during the quarter. The narrative was quite negative, but the quarter itself had many significant events, including quite a few positive ones. We had the budget. I think the key takeaway was continued fiscal prudence, with fiscal deficit pegged at 4.4% of GDP. The second main focus was on consumption, with the government announcing tax cuts to boost urban consumption. Individuals with salary levels up to 12 lakhs need not pay any taxes now. We also saw the RBI easing regulations through the quarter. In its monetary policy, it cut rates by 25 basis points. It cut CRR by 50 basis points. It also eased regulations, which is positive for the banking sector. It has reduced risk weightage for lending to non-banking financial companies, relaxed PSL norms. All of this should spur credit growth over time. Most importantly, it announced a series of liquidity measures through CRR cuts, open market operations, and forex swaps, with liquidity likely to be in surplus now. These are definitely good news from India macro perspective. Also, inflation levels have subsided. The headline inflation reduced to 3.5%, led by lower food prices. That's on the domestic front. On the global side, Europe is where data points are encouraging now. The European markets have rallied by 5% over the last 3 months. The European Union and Germany has announced large fiscal spending. They intend to spend 2.2% of GDP annually over the next 10 years on defense and infrastructure. This will have a multiplier effect on the economy, which should spur GDP growth for Germany and the European Union. Also, the peace agreement with Ukraine, if concluded, should lead to lower power cost and lower input cost for European companies. Markets have responded. The European index is up 5% over the last 3 months. Germany is up 10% over the last 3 months. The US has been a very different story. President Trump's tariff policies is a key focus of discussion. Since assuming office, Trump has announced multiple tariffs on its trading partners. This includes 20% tariff on China, 25% on some imports from Canada, and 25% on steel and aluminum. And finally, on 2nd of April, President Trump announced a 10% baseline tariff on all economies and individual reciprocal tariff of up to 49% on some economies from 9th of April. India has been levied 26% tariff. China tariff is now 54%, but these are initial days and countries will negotiate. Overall, India is better placed than other countries considering lower tariff and lower reliance on exports. Clearly, this has created uncertainty for global trade and even the US corporates. The US Fed has revised the GDP growth forecast for the calendar year 2025 to 1.7% from 2.1%, while raising inflation expectations for the year. This is negative for export-facing sectors. We saw the second-order impact in IT sector in India. However, the good news is US yields have corrected by 60 basis points over the last 3 months, and the dollar index has corrected to 102 levels. This is good news for emerging markets as FI flows, which have been negative so far, can reverse. Coming to FI flows, the initial 2 months saw heavy FI selling with outflows of $14 billion. With lower US yields and the dollar index depreciating and fall in Nifty valuations, FI outflows velocity has reduced. The March saw minor inflow and data for April 2 is encouraging so far. Finally, we will talk about earnings. The fourth quarter earnings season will commence shortly. As you are aware, we started the year with high earnings expectations. However, 1Q and 2Q results disappointed, and we did see earnings expectations being cut. The third quarter saw improvement in earnings, especially large cap and even mid caps. We think this trend will continue in fourth quarter as well. The good part is the base is getting favorable, and as we get into the next few quarters, the earnings growth trajectory should improve. There are multiple drivers for this. The government capex has seen an uptick over the last 5 months as compared to decline in the first half of the year. Most segments such as the roads, railways, defense, the government would meet its revised guidance. This should drive demand. Second, consumption should see an uptick led by tax cuts and higher credit growth. The RBI has also eased norms for lending. And finally, a higher reservoir levels and normal monsoon should drive some uptick in rural consumption. In that sense, we think FY26 would be a year of two halves with heightened global uncertainties and weak earnings trajectory in first half. Second half should see improving global sentiments and improving earnings trajectory for India. And we think FIs will respond to this positively. Finally, coming to valuations, with indices correcting, valuations are near long-term averages, which is attractive. Earnings remain a primary driver for stock price appreciation, and we think with revival in earnings, it should lead to appreciation in indices as well. That's all from my side. Thank you all for the patient hearing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.